Hello, I'm Alex Davies, founder of Wealth Club, and today I'm with Jonathan Moyes, our Head of Investment Research, to talk about our new Wealth Club portfolio service. It's a service designed exclusively for high net worth and sophisticated investors for a long-term home for their wealth. So Jonathan, this portfolio service has been actually a long time in the making. Tell viewers, what is it? What can it do for them?
Yes, it's actually been 2 years since we first started interviewing fund managers in this very room, actually. So a long time in the making. Great to see it finally launched. And great to see the initial reception as well, actually. It's been so positive. Ultimately, the service was designed for people like you, actually, Alex. So people who could really do with a good tidy up of their investments. Maybe they've collected lots of investments over the years and now they're wondering, how does it all fit together? So it's mainly for those clients and clients who are looking for a good long-term home for their wealth. And so what we offer is really, it's a really straightforward, simple service. There are 5 portfolios to choose from. They're available in an ISA, a SIP, and a general investment account. And really, we're taking an existing investment approach, and that's to blend low-cost index funds with specialist actively managed funds and investment trusts. And then we take that investment approach and we combine it with an online service. And that way our clients get a competitive, well-diversified wealth management portfolio. But because it's all online, it's at a much lower cost. And it's typically up to 40% lower cost than using an advisor.
And who's the portfolio service for?
So we think there are probably 4 client groups that could be interested, or this service could appeal to. The first, really, it was modelled on yourself, wasn't it, Alex?
Indeed, yes.
The first group, DIY investors. So those clients that have built up a collection of investments over the years, and perhaps now they're wondering how they all fit together. Perhaps it's become a little bit unmanageable, or they may have just fallen out of love with managing their own money, and they can no longer feel that they can give it the time needed to really do it justice. So DIY investors are probably the first group.
So as you say, that's like me, because actually I got the investment bug when I was 13 years old and started buying all the government privatisations, then started buying funds and various different things. And I got to, it's really about 4 years ago when I met you and employed you, and I looked at my portfolio and I got you to look at my portfolio. And it really was this big mishmash of different funds, shares, things which were great at the time, and I think some of them still were, but there was also a huge amount of overlap where I was in funds which were all investing in the same thing, and it was really starting to worry me.
That's it. I think for most investors like what they like, and they tend to buy a certain theme of investment. So for yours, definitely, and it was probably partly coming from the Hargreaves Lansdown background, equity income was a huge part of your portfolio. So I think people are aware that they need to buy different investments, but typically they all fit within a particular mold. And that really just means your range of outcomes is really quite vast. So that style of investing is either going to do extraordinarily well or not. It was a portfolio that was in need of a bit of a tidy up. So ultimately what we're offering those DIY investors is a very efficient, easy way for them to tidy up their portfolio. So it's a very quick transfer and they end up with something that's very well diversified and very sensible long-term home for their wealth. And then the second group of investors we think are those that are currently with an advisor or a wealth manager. Perhaps they haven't heard or seen from their advisor in quite some time, but perhaps they're paying lots of ongoing fees. Those investors, we think, if they're able to choose a portfolio that's right for them, because with this service, we're not providing advice, if they are able to make that decision, then they could save a substantial sum over time transferring to the wealth.
How much are you talking about?
Well, we think it's up to around 40% of what they're paying with an advisor. So our ongoing costs are around 1.1, and typically you're paying around 2% if you're with an advisor. So quite a substantial saving over time.
And the third group of people?
So we think today lots of investors have various different pots dotted around all over the place. So lots of people have multiple careers. And so for clients who have pots of money scattered everywhere. This should be a service where it's very easy just to consolidate all of those pots into one pot. It's much easier to manage. It's one number, and you end up with a decent competitive wealth management portfolio rather than lots of individual pots.
And although I'm, for example, giving the control of the investment decisions to you now, I think it's very important. I actually feel much more in control of my investments than I did when I was managing them myself, especially towards the end.
That's true, and it's a very easy service to switch into and obviously switch out as well if need be. And it's just a very simple online service, isn't it? And then there's a final fourth group of investors, those that have received a lump sum. So whether that's through the sale of a business or inheritance or a large bonus, those investors are faced with a choice between either really spending their time to do that justice and to invest that money wisely themselves, or go and see an advisor. And on the one hand, it's going to be an awful lot of time to manage your own money and to really do that justice. Some investors will take on that challenge and will enjoy that process, some won't. Or you pick an advised route, in which case there's quite substantial initial fees, quite substantial ongoing fees. And so we feel that for those investors, there's that in-between piece where this service could save people a great deal of time and money, providing they can pick their own portfolio, because clearly we're not giving investment advice.
So how are these funds invested, Jonathan?
So there are, a choice of 5 investment portfolios. So there's conservative, balanced, income, growth, and adventurous growth. Within each portfolio, we have typically between 30 and 45 underlying funds, so really well diversified. And that's really absolutely key to how we invest. So we're looking to build, these are portfolios designed for high net worth investors. We're looking to build a great deal of diversification into our portfolios, but also we pick very specialist active managers that focus just on one part of the market and become experts in that particular part of the market. And so because we're picking those investors, we need lots of them to create the diversification we're looking for, which is why we need 30 to 45 underlying funds.
And what about your approach? How do you build these portfolios and how do you select the funds?
Well, everything an investor needs to know about how we build our portfolios can really be covered in 5 key investment principles. So those are no crystal balls, no heroes, no jack of all trades, no excessive trading, and no excessive fees. So if we take the first one, no crystal balls, we don't believe it's possible for anyone, any team, any asset manager to accurately and consistently predict the future. And so we don't believe in making big asset allocation bets. You're never going to see us say Japan's the next best region to invest in, or the US is overvalued, or you're never going to see us make these individual asset allocation decisions. And the reason for that is if nobody can accurately or consistently predict the future, there's no reason to believe that approach will add to your longer term returns. And one thing we know for sure from that approach is that it will add risk to a portfolio. So if on the one hand, we're not convinced it will add to our long-term returns, and on the other, we know it will add risk, then that's just a really poor trade-off. And so we won't do that. And so that's no crystal balls. Just maintain a solid, well-diversified portfolio at all times. And if investors look back at a period in time where there's been a recession or a big market downturn, nobody looking back on their portfolio during those moments has ever said, God, I really wish I wasn't so well-diversified during that market downturn. So point 1 is always maintain a well-diversified portfolio. Principle 2, no heroes. Well, that's just we back lots of specialist active managers. And so we want to limit our exposure to any one individual manager. And we limit that at 5%. And realistically, 3% for some of the higher risk positions. And we do that because we don't want any one individual fund manager to have an outsized influence on the performance of our portfolios. And if you just take those first 2 principles combined, maintain a solid, well-diversified portfolio and never have a fund that can have an outsized influence on your portfolio, well, then you've just created a really solid portfolio. And that's a great starting point from which to build a decent, competitive wealth management portfolio.
And you sort of talk about no jack of all trades. What do you mean by that?
Yeah, so no jack of all trades. That's all about how we pick active managers. So ultimately, in every walk of life, we believe specialists outperform generalists. And so when we're looking to back active managers, we're always asking the question, is it reasonable to believe that this team or this manager or this firm has a competitive advantage over the average market participant? And for us, that's the average investor is a jack of all trades investor. Most fund managers will try and do a little bit of everything, and they'll base their investment decisions partly on their view of where we are in the business cycle, or where we are with interest rates, or where we are with inflation. We're much more focused on the fund managers that just define really quite tightly their niche in the market. So it might be that they look at very high quality companies only, or sort of cheap turnaround situations or contrarian stocks. So managers that focus on one specific area, that's what we like. And teams that focus on that one area and just look at those stocks year in, year out, decade in, decade out, we feel they become experts in their field and they have a competitive advantage over a jack of all trades investor that might only spend 10% of their time in that particular part of the market. So that's jack of all trades.
And low trading?
Sort of no excessive trading. Ultimately, if we get our first three principles right, so solid, well-diversified portfolio at all times, no big asset allocation bets, no individual fund manager having too large a position in the portfolio, and all the active fund managers that we back, they've been doing something very specific and they've been doing that for years, if not decades, well then naturally we should have very low turnover. We feel that, based on our research, trading, particularly trading in open-ended funds, is a really bad idea and it costs a lot of money over time. We think it can cost up to about 2% per annum based on sort of 2,500 or so funds that we've looked at. The average investor, whether that's a DIY investor or a professional investor, tends to buy funds after a period of strong performance and sell them after a period of weak performance. And if we can resist the temptation to trade, that's beneficial in our view to our longer term returns.
So when do you know that sometime it must be the right time to sell? When do you sell?
Yeah, so selling is all about drifting away from a specialist investment approach. So for us, we almost don't look at performance when we're picking an active manager. It's the very bottom of our list. And to get to that point, you've got to be, there's a great deal of hurdles to get through from manager strategy, process, portfolio. To sell a fund, it's got to be due to drifting into a different style. So if a fund manager says, Alex, I'm fantastic at turnaround situations, it's all I've ever done, it's all my team's ever done, and we've done this for 40 years, and we've only ever looked at turnaround situations. If they come into this room for an annual update and they say, do you know what, actually, we really quite like high quality companies, well then, we've done a whole load of work to establish that they're experts at turnarounds. They've been doing quality stocks for 5 minutes. We're not going to hold them. So we'll sell them based on a drift in discipline rather than performance.
Okay.
Really.
And your final criteria?
Final criteria, no excessive fees. That's fairly straightforward, tangible. We're using our online service to lower the cost for investors. And the fee impact can be really quite substantial over time. So the example we use is if you take two £1 million portfolios, both growing at 7% per annum before fees. One has fees of 1.1%, which is roughly where we are, and one has ongoing fees of 2%, which is roughly where an advised solution would be. Over 25 years, the 1.1% portfolio will be worth £805,000 more than the 2% portfolio. So 80% of your starting value, essentially, which is a huge impact. And that's the benefit of compounding those fee savings over time, because all those fee savings remain invested and can continue to grow.
So give me some examples of the funds in your portfolio and why you chose them.
Sure. So if we think back to the no jack of all trades principle, I think a really good example of a specialist active manager that we like to back is probably a Comgest. So Comgest Growth Europe is one of the funds held across our portfolios. Comgest is an investment boutique founded in 1985. And for the past 40 years, all they've done is their own particular brand of quality growth investing. So it's a reasonable size investment boutique. It's got around $30 billion of assets under management. It's got around 50 investment professionals within the business. And the key thing we like with Comgest is, yes, they have this really well-defined investment process, and they've been doing that for 4 decades. And they've got quite a large, well-resourced team. Every member of that investment team has equity in the business, so they're all really tied in. So yes, you want a team that's been in place for ages, looking at one particular style, that's what we look for. But to have the additional equity ownership, it just ensures that the team's very well aligned with the longer term objectives of the firm, and it means that the team's more likely to be in place for longer. Long-term performance has also been really strong. So a €10,000 investment back in December 1993 would today be worth €167,000. And that's roughly 2.5 times more than had you just invested in a tracker.
Okay.
So it's one of those firms where it's very well resourced. It's got a culture and a philosophy that's based around its quality growth investing approach. The employees are all brought in with equity. It's very unlikely to drift away from that particular style. And longer term track record's been fantastic. So Comgest is a really good example. And another example is Fidelity Special Values. So within our portfolios, we back investment trusts. And I think we're fairly unusual in backing investment trusts as an online service. I think I'm yet to find an online service that uses investment trusts within their proposition. It tends to just be sort of passive-only portfolios. So a good investment trust example, Fidelity Special Values, it's an investment trust that backs out of favour cheap UK stocks, of which there are many today. It's followed that investment approach since 1994. Alex Wright, he's been in the chair now for over 10 years, very passionate portfolio manager. He's done a very good job. And longer term, the track record of that trust has been fantastic. So a £10,000 investment back in 1994 has grown to be worth 231,000 today. So that's almost 4 times more than had you just backed a tracker. And it's never had a 10-year period where it hasn't outperformed the UK market. And what we find really interesting with the investment trust is it's also got a sister open-ended fund. So there's a choice here. If you want to back that mandate run by Fidelity, you can choose the investment trust structure, or you can choose Fidelity Special Situations, which is the open-ended equivalent. Over the past 20 years, that investment trust has outperformed by 4% per annum on average. And we think that's because it invests in illiquid stocks, sort of contrarian parts of the UK market, and it's a lot easier to invest in those particular stocks within that sort of permanent capital structure of an investment trust. So the structure is just much more suited to their style of investing. And since we can invest in trusts, we can take on that opportunity where others can't.
And your final example?
Yeah, so probably sticking with the investment trust theme, but going a little bit off-piste. So investment trusts are essentially investment companies that are listed in the UK. We see no reason why we can't also look at investment companies that are listed in the US. And one of the examples that we have in portfolios is Brookfield Infrastructure Corporation. So infrastructure as an asset class we like. It provides typically a reliable income stream, and there's normally some inflation protection along the way, so you get a steady and growing dividend stream essentially from infrastructure. That's why we like it. Brookfield Infrastructure Corporation is managed by Brookfield Asset Management, unsurprisingly. Brookfield's one of the largest infrastructure investors in the world. They have over 800 billion under management, more than 250 billion within infrastructure. And they're slightly unique for an asset manager in that they don't just buy assets, they also operate them. So they have this sort of immense scale as a business, but they also have around 200,000 operating employees. And so all of this sort of information is feeding back into Brookfield as an asset manager. And we feel that their insight into private infrastructure assets is as good or better than anyone else's. And they've got a great track record of sort of acquiring and then enhancing and then exiting sort of large-scale infrastructure projects. So they recently bought 41,000 mobile phone towers in Germany, for instance. So that mission-critical infrastructure that's providing a decent income stream that's growing over time. And with Brookfield, what we particularly like is the dividend growth track record. So for that trust or that investment company, $1 of dividends paid in 2009 has grown to $3.80 today. So really strong dividend growth. And looking forwards, the team are confident of growing that dividend by between 5 and 9% per annum. And it's currently on a dividend yield of around 4.5%. So if you take those combined, 4.5% yield, 5 to 9% growth, if they can achieve that, that's an equity-like return. But we're getting that equity-like return not from a portfolio of global stock market trackers, but from infrastructure assets. So you're getting that diversification benefit within portfolios as well. So a good example, Brookfield. We're very keen on Brookfield.
So Jonathan, to sum this up, why should people choose the Wealth Club portfolio service?
Well, I think we should turn this one back on you, actually, Alex. You've invested a substantial sum into the service. What were the main factors for you?
Well, I think it all goes back to I suddenly got this mishmash of different investments. I started investing when I was 13. I then worked for a company that became very successful and was able to build up a very big portfolio. I then haven't actually worked for anyone for the last 10 years, and in that time I've set up Wealth Club and I've used my portfolio to live on and to fund Wealth Club. So my circumstances have changed all along the way, and I've had children. And then maybe 3 or 4 years ago when I first met you, I looked at my portfolio and it was actually quite scary with this big variety of different funds, quite possibly all invested in the same thing, lots of different shares, and I really didn't feel in control of it. And I think I was taking far too much risk. So by transferring my money into this service, it's given me an enormous peace of mind. I think I've got a really good portfolio in really good funds that fit very well together. And it's a very low-cost service. I'm sort of paying a very similar amount to what I was paying when I was doing it all myself. In fact, it's probably a little bit cheaper.
And just to add as well, I guess, first and foremost, clearly we want to build well-diversified portfolios for our clients designed for high net worths. But we also, over the longer term, want to outperform the average wealth manager. So I think there are 3 key competitive advantages available to Wealth Club in seeking to outperform the average wealth manager over the longer term. I think the first and clearly most tangible is fees, being up to 40% lower costs. Having those savings compound over time is a real head start on the competition. I think the second thing is being able to buy investment trusts, because a lot of the larger wealth managers are unable to buy them. I think there's some real gems within investment trusts. I think the performance of the investment trusts should shine through over the longer term, and that should add to our performance. And third and finally, having a diverse portfolio of 30 to 45 underlying funds means, yes, we're very well diversified, but also that basket of complementary specialist active fund managers, I think also should shine through in performance over the longer term. So those are really the 3 key reasons I would say are why we believe we can outperform the average wealth manager.
And I thought I just want to clarify something. We talk about that I put a substantial amount of money into this. I have, and the overall aim is that actually I will put all my money, which is currently in funds and shares, either in this portfolio mostly and also into Charlie's quality share portfolio. And the only reason the entire amount isn't currently in these portfolios is purely tax reasons, because I'm gradually trying to sell them and manage my tax bill as I do it. But, I've got full commitment to these funds, and we've sort of designed them partly to help me manage my own money.
That's very true.
So to finish off, finally, where can investors find out more on this?
So investors can find out more about our investment approach, the portfolios, what's in them. All of that's online at wealthclub.co.uk.
Thanks very much, Jonathan.
Thank you.